Picture this. You open a travel app and see that $1 buys less than €1, but that same dollar buys tens of thousands of Vietnamese dong. It feels wrong at first glance, like money should have one universal value. But a currency is not a single object with a fixed worth. A currency is a price on an entire economy, and that price moves whenever the world's demand for that economy changes. An exchange rate is the price of one currency in terms of another. If €1 costs $1.10, that means people are willing to give $1.10 to get €1. Like any price, it is set by buyers and sellers. The buyers include tourists, importers, investors, and companies that need euros to pay European suppliers. The sellers include exporters who earn euros and convert them, investors who move money out of Europe, and anyone who wants dollars more than euros. So, why aren't all currencies equal? Because what you can buy with a currency depends on what a country produces, how stable its rules are, and how valuable it is to hold that currency compared with other options. When you hold dollars, euros, yen, or dong, you are holding a claim on what that country can reliably deliver to the world: goods, services, assets, and credibility. Before we break down the modern forces, it helps to understand why exchange rates used to be more stable. For much of the 19th and early 20th centuries, many countries operated with versions of the gold standard. Under that system, a currency was tied to a fixed amount of gold, and central banks promised to exchange currency for gold at that price. Because gold had a global market value, tying currencies to gold indirectly linked currencies to one another. Governments also faced a hard constraint. They could not expand currency faster than their gold reserves without risking a loss of confidence and gold outflows. Over time, those constraints became a problem. Economies grew faster than gold supplies, trade expanded, and governments wanted flexibility during wars, recessions, and financial stress. By the mid to late 20th century, most countries moved to what we now call fiat money, currency issued by the state and accepted because people expect others to accept it tomorrow. Fiat does not mean worthless. It means the value comes from trust, institutions, laws, and real economic capacity, not from a metal stockpile. In today's world, exchange rates change constantly because the forces underneath them are constantly changing. A helpful way to think about the exchange rate is that it summarizes 5 questions. How strong is domestic purchasing power? How attractive are local returns for investors? How safe is it to store wealth there? How much does the country need foreign currency to buy what it consumes? And how much does the rest of the world need that country's currency to buy what it sells? Let's start with inflation because it is the easiest to feel. Inflation means prices rise inside a country, which means the currency buys fewer goods and services at home. If a currency is losing purchasing power quickly, people prefer not to hold it. Businesses may rush to convert it into more stable assets. Investors demand higher returns to compensate. That combination usually reduces demand for the currency and pushes its exchange rate lower. But inflation is not a single cause. It can come from supply shocks, energy prices, wars, disasters, policy mistakes, or an overheated economy. What matters for the exchange rate is whether inflation is higher than in other countries and whether people believe it will persist. If markets expect inflation to stay high, they expect the currency to keep losing purchasing power, and they are willing to pay less foreign currency for it today. Next, interest rates. Interest rates are the price of borrowing, and they also influence the returns available on assets like bank deposits and government bonds. If one country offers higher interest rates than another, that can attract foreign capital. But investors do not chase yield blindly. They care about risk, inflation, and what the exchange rate might do while they are holding the investment. Here is the intuition. Suppose U.S. interest rates rise relative to Europe. Some investors sell euros, buy dollars, and purchase U.S. assets. That increases demand for dollars and can strengthen the dollar. But if those investors think the dollar will fall, the extra interest might not be worth it. In other words, Interest rates matter, but they matter through expectations about future returns and future exchange rates. This is why central bank announcements can move currencies in seconds. Markets are not reacting only to today's rate, they react to the path they expect over the next months and years. A single sentence that changes expectations can shift billions of dollars of capital, and the exchange rate updates instantly. Now zoom out to the real economy. What a country sells to the world. If a country exports products and services that the world wants, foreign buyers need its currency to pay for them. That creates steady demand. Countries that export high-value goods, critical commodities, or globally in-demand services often enjoy stronger and more stable currencies over time because the world is constantly buying what they sell. Imports work in the opposite direction. If a country imports more than it exports, it must continually exchange its own currency for foreign currency to pay for those imports. That can create downward pressure on the exchange rate. A trade deficit does not automatically doom a currency, but it means the country relies on foreign capital inflows to balance overall payments. This connects to a major driver: investment flows. People do not only exchange currency to buy goods, they exchange currency to buy assets, stocks, bonds, real estate, factories, and entire companies. When international investors believe a country is a good place to invest, they buy its currency to buy its assets. When they lose confidence, the outflows can be fast and the currency can fall quickly. So what builds confidence? Stability and credibility. Markets care about whether contracts are honored, whether courts function, whether property rights are secure, and whether rules change overnight. They also care about the government's fiscal position, the size of deficits, the sustainability of debt, and the likelihood of disruptive policy shifts. Strong institutions reduce uncertainty, and lower uncertainty increases the willingness to hold assets denominated in that currency. This brings us to safe haven behavior. In global stress, investors often rush into markets perceived as deep, liquid, and reliable. That can strengthen certain currencies even if those countries are not perfect. Safety is not moral approval. It is a preference for liquidity and predictability, especially when people want to move large sums quickly without breaking the market. Another factor is how the exchange rate is managed. Some currencies float, meaning the exchange rate is largely determined by market supply and demand. Others are pegged, meaning the government fixes the exchange rate at a chosen level against another currency or a basket of currencies. Pegs can reduce volatility and make trade planning easier, but they come with a cost. The central bank must buy and sell foreign currency to defend the fixed rate. To defend a peg, a country needs foreign exchange reserves, typically held in major currencies such as the dollar or euro. If pressure builds and reserves fall too low, the peg can break. When a peg breaks, the exchange rate can move dramatically because the price was being held at a level the market no longer supports. Countries choose pegs for practical reasons. Some are small economies tightly connected to a large neighbor. Some peg to import credibility when domestic institutions are developing. But pegs reduce policy independence. If a country wants to keep a fixed exchange rate, it cannot freely set its own interest rates and monetary policy in response to local conditions. At this point, a natural question appears. If exchange rates create friction, why not use one global currency? The appeal is obvious: no conversion fees, no uncertainty, no sudden swings. But money is also a policy tool. Countries face different conditions at different times. One country might be overheating with inflation, while another is in recession. If they share a currency, they share a single interest rate and a single monetary policy, even when their needs diverge. The euro shows both the benefit and the challenge. It made travel and trade easier across much of Europe and reduced currency risk inside the euro area. But it also meant countries with different economies had to live under one central bank policy. During periods of stress, some members could not devalue their own currency to restore competitiveness because they no longer had their own currency. The convenience comes with a loss of an adjustment valve. Another common question is whether a country should want the strongest currency possible. Not necessarily. A strong currency makes imports cheaper, which can reduce inflation and raise consumer purchasing power. But it can also make exports more expensive abroad, which can hurt exporters and employment in industries exposed to global competition. A weak currency can boost exports by making them cheaper, but it makes imports more expensive and can raise the cost of essentials such as energy and food. Most governments aim for stability rather than extremes, because volatility itself can scare away investment and raise the cost of doing business. One more idea is worth knowing: purchasing power parity. In the long run, exchange rates often drift toward levels that reflect price differences between countries because traders and companies respond to arbitrage. But the real world has frictions: taxes, transport costs, regulations, and different products. So purchasing power parity is a guide, not a timer. Currencies can stay too strong or too weak for years if capital flows, interest rates, and risk sentiment pull harder. Finally, why do exchange rates change every second? Because markets process information every second. Inflation data, growth reports, interest rate expectations, political events, energy prices, corporate earnings, wars, elections, and changing risk sentiment all affect demand and supply for currencies. Currency markets are among the largest and fastest in the world, with institutions constantly adjusting positions. The exchange rate is the live scoreboard of those adjustments. So the next time you see $1 equal to less than €1 or equal to thousands of dong, do not treat it as a weird math trick. Treat it as a comparison between economies: what they produce, how stable they are, how they manage inflation and interest rates, and how much the world wants to hold their currency at that moment. Currencies have different values because countries are different. Exchange rates move because the world never stops updating its view of those differences over time.